Hello and welcome back to DoubleLine Channel 11. I'm Ken Shinoda, your host today, with my special guest Jeffrey Sherman, Deputy CIO, for an episode of what we're going to call What Now, which is basically every day in the financial markets, trying to figure out what's going to happen next. But we figure, given we've seen some vol pick up in the marketplace, we'd kind of look at the world and see what's going on. So I'm going to start with my macro themes. I've usually put this together to talk to investors about. Seems like we, as it comes to central banks in Washington, this last Fed meeting was a turning point, right? Seems like they're going to taper asset purchases maybe as soon as November.
Yeah, it was kind of nonchalant, right? I mean, that's what I kind of took from the press conference. It was like Chairman Powell really wanted to come out and say something because he used the Q&A when it wasn't directly asked. He's like, yeah, we're just going to wind this taper thing up by mid 2022. Thanks, move on, right? So it was kind of, cavalier or nonchalant. And the market, it took a little bit of time to digest it. I mean, the dollar the dollar rallied instantly. We saw rates start to push up a little bit. And then after, kind of the analysis came through the next day, that's when the market really started to move.
Yeah, part of it seems like it was not much move in break-evens or people's expectations of inflation, just more of kind of the policy is going to change and rates are probably going to head higher.
I struggle with that because of the Fed's heavy footprint in the TIPS market. Something we've been talking about for the last 18 plus months is that I just don't really read as much from break-even spreads as I used to, because when the Fed owns almost a quarter of that market, and then you have some big institutional buyers that collectively they own almost half the market. And so a lot has been made about that. It's a real yield move. And I agree. I mean, that's what it shows.
Yeah.
But at the end of it, it's really hard to really discern now because of that footprint. But I definitely think it was hey, maybe inflation's not as transitory as we thought. And I know we're going to get into all of that. But I think that's what you saw there. So it's kind of strange to say, well, it didn't really move in break-evens. But if you listen to the pundits and the interpretation, people are saying, well, inflation's maybe here a little bit longer than we think, and therefore rates should be higher.
And even Powell came out and made a statement about, the supply chain disruptions seem to be lasting longer than even he had expected. Yep. And so inflation could be around for longer than we had thought. And voila, long-term rates started rising. So, it could be one or the other, but those are the two things that, at least the two market narratives that are out there. Which one's right or wrong, only time will tell. Spend. I guess they're voting imminently on passing the infrastructure bill, whether it's half a trillion,
half a billion, nothing,
or a trillion, and then $3 trillion of fiscal stimulus potentially. So that's all positive for the economic growth. We continue to see kind of strong expectations of growth across market economists out there. So it seems that from a growth standpoint, things are looking okay into the kind of the medium term.
Yeah, I mean, I'm getting tired of hearing the stagflation narrative, because it's like, okay, we've had peak growth rates, but it doesn't mean that we're just stagnating in growth, right? The expectations for next year's GDP is a 4 handle on real, and you slap the inflation environment, that means we grow somewhere probably between 7.5 nominally next year. That doesn't sound like stagflation to me. So I think people are being a little too loose with that phrase. And I saw some research from Deutsche. They came out and showed the growth rates and expectation of inflation this morning. And he said there is no perfect definition of stagflation, but he said, okay, let's call it a 1 to 1.5% real yield growth, or real growth rate, and then a 3+ inflation rate. So I think everyone's focused on the 3+ inflation. They're looking at this idea that we're going to slow in terms of growth. But remember, we just got the final print of second quarter GDP. It was 6.7% this morning. And it's going to decelerate, but deceleration is still growth. It's like tapering. Tapering is still buying bonds, just buying less. And so, it's one of those things where I think too many people are trying to really jam down this. We haven't seen inflation in a while. Oh, it's stagflation. But I think we're still poised to have a decent growth rate in 2022.
Sure. So as far as growth, seems like going to still see some strong numbers, and we're going to see elevated inflation. Coming to the bond market, we just talked about that as far as real rates being negative, having repriced a little bit after the Fed. So that goes to kind of the consumer and corporate balance sheets. I do a lot of investing in mortgages, and one thing that I always talk about is the consumer is in a good spot because the savings rate's high, rising incomes, and we've seen delinquencies be very low. They're starting to pick up a little bit because the stimmy checks have run out. They're kind of going back to normal, and we're seeing the worst performance, the ever so slight increase in delinquencies on the worst FICO scores or the worst credit. So
shocking.
It's not anything that's out of the norm. Things are just kind of normalizing. And one thing I've told investors is don't extrapolate the weird performance that happened right after the pandemic. There's a lot of stuff going on behind the scenes that caused things like these supply chain disruption, things like these savings rates spiking. So,
and don't forget, we saw finally in the jobless claims data, we get that data weekly, it's with the 2-week lag, but you actually saw that there was this big drop off in continuing claims from these extraordinary measures, right? The PUA, the Unemployment Assistance Program, and the emergency unemployment claims. And so if you look at that, there were 6.8 million fewer claims in this last reported week than after Labor Day. And not shockingly, the programs expired, right? Or a lot of them did. So I think that's something to really focus on when we talk about the consumer. I know your team's doing that with the ABS team, looking at all the delinquency stuff. So I think we're at a critical juncture to see, is this narrative of all these unemployment benefits, keeping people on the sidelines from working or not? And I think that narrative will be challenged. I think that, there's just been some changes in lifestyles and decisions, but I think the next couple of months of data when it comes to income, spending, and consumption are going to be very important to see were we truly dependent on these policies and these extraordinary programs.
And we have some slides to talk about some stuff like that a little bit later. Corporate balance sheets, just like the consumer, the corporate balance sheets seem to have healed. Everyone's went out and borrowed hundreds of billions of dollars at the lowest rates ever, the tightest spreads ever. And so corporations seem to be in a decent spot. If you look at the high yield and bank loan default assumptions in the marketplace, seems like the performance of credit should be okay here, both consumer credit and corporate credit. Valuations, obviously a different story.
Yeah. And I always think about, when I think about default cycles, is one of the critical junctures becomes maturity walls, right? And so as you mentioned, not only has it been financed, but it's been financed for longer tenors, right? And so what that means is that we don't have these impending maturity walls, which tend to cause problems because the bills do, right? So it's not just to carry the coupon. So, if you look at the maturity walls, they've been extended out a couple of years. So the default environment does look benign. Obviously, exogenous shocks can come in and things get disrupted. But, for the pathway of the next 18 months or so, corporate America looks very strong. We can talk about how rates go and refinancing that debt in the future, but that short to medium term, it's still pretty attractive from a default perspective. Valuation, we can always argue about that.
And then we go on to kind of the recovery and the reopening of economies. One of the things that I think drove the second quarter and third quarter narrative was obviously the Delta variant. People expected the economy to slow as a function of that. People's behavior changed, both businesses and consumers. Rates came down, we think partly as a function of the Delta variant. Now with peak kind of COVID, at least in the near term, behind us, one of the reasons rates could be potentially rising, and also more optimism about fourth quarter retail sales and things like that as Christmas approaches. So clearly, from an investment standpoint, we're watching that data. We'll show you some of that in a second. And with that decrease in the COVID cases and this rise in rates, some of the reflation trades that worked in the first quarter didn't work in the second quarter. And third quarter, they're starting to work again, at least very recently.
Yeah, we've identified some of those in our charts, so let's jump into it.
Okay, well, last time we met was March of 2021. We thought inflation was going higher. This was before CPI.
Good job.
Yeah, we'll take that one win.
We nailed it, but sorry, it's not a good thing to nail, right? That inflation was higher, right?
And the data is coming in hot. It's slowing down a little bit. On the fixed income side, we thought that the long end was a little oversold. When we looked at drawdown charts, it was oversold, but we did think the trend was rates keep going higher. They've rallied, so we got that wrong a little bit, but they're starting to go back up again, and we think that's going to continue. And of course, we thought about the reflation trade, value over growth, non-US equities. Guess what? USA still winning. So US has definitely still been the place to be. It's been like that for, seems like a decade. At some point in time that might turn. And of course, in this inflationary environment, commodities would do well, and they have done well. They took a little bit of pause in the third quarter, went sideways, but it seems like...
Yeah, it seems to be off to the races again, too. And there's been changes in leadership, and we can talk about this later, but you've seen the commodity complex where it was industrial metals and that true reflation, restocking.
Copper,
nickel, zinc. And then we moved on to agriculture and some of the energy reflation. Then all of a sudden, now we've got an energy problem again. And as our global PM was pointing out on our investment call this morning, this idea that the decarbonization is driving energy prices higher. And I had to point that out. It's how perverse that is, right? We're going to decarbonize, and it's made carbon prices more expensive, right?
Yeah.
So, but again, these are short-term things, but I think that there's still supply problems, and I still like the commodity trade. I think it's something that's under-owned still, and something that can be accretive.
All right, so from a now what standpoint, here we are end of September, last day of the quarter. Fixed income, we still like being short in most of our intermediate term funds. We're running short duration relative to the index. We still think that inflation is going to be around a little bit longer than, let's say, the market thinks, and it seems like the market's trying to agree with that.
And that's why I had this disconnect about break evens, because from our internal modeling, and look, we're not inflation experts. We do the best we can with the data set, and we're digesting it as well. But we're showing that inflation next year is probably going to run in the 3.5% range or higher, right, with upside to that. And so we talk about break evens, and all of a sudden the break evens haven't moved. They're sitting like 270 for like the 5s and the 10-year. And so there is a disconnect there. But potentially that market's saying, okay, it's going to be transitory. It's going to be 2-3 years of this higher level of inflation. But I just find that to be very challenging right now, because there's really no signs of this waning. And again, we have more charts on this. So
yeah, it's a thinly traded market, the tips market,
yeah.
So it can be distorted. So we like low duration assets, and higher yielding credit could do okay in this environment. But of course, as rates rise and those real yields rise, potential for some volatility. We're already seeing it, right? I mean, the stock market is trying to kind of figure out what to think about rates, and it could create some repricing.
Yeah, I saw the headline that September's on pace to be the worst month in the stock market since March of 2020. And I'm like, okay, but the drawdowns are slightly different here.
Yeah, just a little bit.
Yeah.
Equities, we think, of course, what's worked in the past may not work in the future. This is a line from a presentation you put together, I think, earlier this year, and it's almost like we could reuse it, because I think a lot of the stuff that looked cheap then still looks cheap.
Well, you said this to me, I was like, that looks very familiar.
Yeah. I'm like, it should. You wrote it.
Okay.
So, of course, the equity market is very rich relative to history, looking at a lot of metrics, but there's definitely still parts that offer relative value. Of course, value equities, European equities that have looked cheap forever and ever and ever and still underperformed, and emerging markets, especially if we see a weaker dollar. I know off the Fed, the dollar is strengthened, but with deficits, we think the long-term potential for the dollar could be weaker, and that would be good for these kind of non-US equities. And of course, commodities we just talked about. We think commodities are a good play.
And look, commodities have been strong in the face of the stronger dollar, and that's something we keep talking about in our weekly macro meetings, is how impervious this has been, except for potentially gold and silver, which are kind of more trading off the real yield component as well. But given the strength of the dollar and commodities have hung in there, we think that portends well for the next 18 plus months, especially if that leg in the dollar does move down.
Yep. So 2021, this is from our one of our weekly macro meetings that we have, and we always look at COVID charts, and we've been calling it the COVID years, and it's going to keep going. 2022 seems like it's going to still be another COVID year, of course.
Well, they've rebooted the Wonder Years too. That's what I always think of when I see the COVID years. So.
But here's a quote from J.P. Morgan. In our view, it's very possible that the Delta variant is around half as infectious as initially assumed. This would be obviously a very positive thing going forward and would limit any increase in infections in the coming months. So of course, if there's less worries about COVID, there's more economic activity. This is all positive for economic growth. This is developed markets COVID cases. They've peaked. They've been coming down. Emerging market cases, maybe not as great as data, but they've also been coming down. And one of the big things our emerging markets team was always pointing to over the last, call it 12 months or so, that was that the vaccination rates were, not 12 months because the vaccines came out in November, but since the vaccines rolled out, EM was behind the curve. And so they thought that the valuations of EM had gotten ahead of, let's say, the fundamentals, but now the EM countries are catching up from a vaccination standpoint. So that's something that could be also a tailwind to emerging market equities, especially if both this is happening and commodities are doing well at the same time.
This also causes problems in the supply chain, right? Because as we reopen, and this has been the thesis for why Europe and why EM, is that you get this reopening construct, and all of a sudden there's this newfound marginal demand, right? Where you've had these lockdowns and they were trailing, let's say, the US. And so I think it is very supportive of these markets. And I guess it's fool me once, fool me twice. You joked when I said, well, Europe looks cheap. You're like, it always looks cheap relative to the US, but it does seem that this is its moment, right? And you're seeing more inflation and things there too. So it may hurt real growth a little bit, but the nominal growth is going to be there. And so, it's hard to really see the supply chains stuff going away. And it's just going to take time to resolve. And unfortunately, the cure for high prices is higher prices.
Mm-hmm. All right, so we're going to split this up into two sections. This first section is going to be about fixed income and inflation, and we're going to kind of dig deep into it. Fixed income last year, this was flipped. Everything on the left-hand side that was high quality was up a lot with rates falling, rates bottoming with the 10-year around 50 basis points or so. On the close intraday, I think it got down to 31 basis points. And then, of course, this year, a different tune, rates rising out of the summer of last year, and all the stuff that lagged is doing really well. So the risky stuff, CCC bank loans, CCC high yield, huge winners. CMBS, which got hit hard because of COVID, and of course, stocks are doing great. Not part of the fixed income universe, but we just throw that out there for relativity. That's kind of been the year so far. And here's rates having bottomed in the middle of 2020. It seems like we sold off hard off the 50 basis points. We hit about kind of 73 or so on the 10-year. We rallied back down pretty hard.
We got low 120s even there too, and
1126 was the intraday low on the 10-year, I think, or 1123, and then now we've backed off again to we think a pretty critical point. This kind of 155 pivot. These charts don't go back far enough, but it's kind of a critical point right now. And if we break above this, we think that there's room for rates to kind of go higher here.
Well, let's look at the 2-year too in the upper left there. I think it's amazing because we talk about how the repricing of the market's taken place and potentially moving the rate hike calendar forward from expectations, and look at it in the context of history. You can't even see it, right? And so, to me, the more critical one is the 5-year, because that is the health of the economy as people look at it. 2 years is going to be policy rates at the end of the day. And we're sitting above 1% now at the end of the quarter here on that 5-year rate. And if you look at that chart too, it's got a pretty good big gap up if you're a technician, to about 150. And getting there, that's going to reprice a lot of credit if that happens. And so, you were talking about that too. Like, it's not just the health of the economy, but because yields have been low and there was this complacency in the market. I mean, the 10-year traded over 3 months in like a 15 to 20 basis point range. And we saw a 25 basis point move in a week, right? And so this just shows that once that momentum starts to build there, it's repricing the curve in general. And so some of that credit on the front end, even though it's been places we've been hiding, is a little sensitive to this latest move. And so I caution people when thinking about the high yield trade, although we like the default environment, it's keyed off the 5-year. And remember, these bonds trade yield to call like 60+% of the market. And so the wonky term is called convexity, so the duration can extend as that happens out too. So even though the credit is accretive, if this inflation narrative takes hold, it can be challenging for some of these credit markets. So, I think we're at some critical levels, and when we revisit on the what now next time, we'll see how that all played out.
And that's one of the reasons we like bank loans over high yield. If you're going to buy risky credit, we think the bank loans is a.
Hey, and look, you get some optionality on the Fed if they decide they want to hike a little earlier. Maybe that gets priced into the LIBOR or SOFR curves or whatever our reference rate's going to be in the next year or two. And so. There is something to be said about that. So, as we've been saying all year, duration. It's very important, and it's not just portfolio duration; it's key rate duration where you're on the curve. And as we've seen this last move, 2s and 5s have moved a fair amount. And so, even hiding those areas, they haven't been the offsets they were, let's say, in the first quarter of this year.
Here's some seasonality. I mean, we look at a lot of charts. This is all going to be kind of showing you maybe why rates are moving higher. In the summertime, seasonally, rates go lower, and in the fall they tend to rise. Just something to look at. Obviously, it doesn't happen every year, but just another tool in the toolkit. And then we often talk about the rally came for a couple of reasons. You had pension fund rebalancing. You had the foreign buyers come back in, as this chart shows. You had some short covering, of course, and then you had the Delta variant.
Well, you also had the change in the leverage ratios. Remember, there was the extraordinary measures passed. And I don't think this is given enough credit to the rate rally we saw, because what you found is that, when those leverage ratios were reduced, so they had to, the banks were required to hold more tier one capital assets, so high credit quality. What you saw was banks pile into the agency mortgage market in the second quarter, and they started like clockwork the first business day when that needed to come through. We heard it from our agency team, every single week. It's bank buying, bank buying, bank buying. And that's very important because it is an interest rate sensitive asset. And like people think, oh, the housing market's so strong, the Fed's buying mortgages. Well, it's a fungibility between the treasury market and the agency mortgage market. They're rates trades, right?
Yeah.
So what you saw there was that high quality bid help kind of bring rates down, as well. And so it's the confluence of all these things. And don't forget, I know I made you put a chart in here too later on about the net supply of bonds too, because we talk about deficits. But remember, Treasury had a huge balance sitting out there in its general account, sitting at the balance sheet, which has been drawn down. So I think, if you do the order of operations, it's the way you describe them. But I think that bank bid that came from the SLRs being reduced, and then also just this technical aspect of
less
supply of bonds out there drove it down. And now what you have is more of a balance of things. And so that's why I think, given the Fed kind of shift in rhetoric, I think we are at some critical junctures to watch here. And we've been very cautious the last week or so. We don't really want to step in front of this. We're thinking, should we be extending duration a little bit to take a little bit of advantage of this? And right now, we just think that it's such a crossroad that we're kind of keeping our guns to ourselves, or we're sticking to our guns, I should say. And just letting the data play out over the next week or so and watch how the market digests that.
Yep, here's that supply you were talking about, showing that it was...
Yeah, I mean, it's pretty amazing too, because the Treasury general account balance, and this is like nerdy stuff that we get into with our government team and everything, but the balance sitting there was like $1.8 trillion. And that got removed out of the system, at least $1.5 trillion. I'm missing my billions and millions too here. But if you think about that, the absorption of that supply into the market, you had this net supply drop of roughly over $1 trillion of treasuries. And the market rallied how much? Like 30, 40 basis points. So that just shows you at the margin what can happen. So if we get these spending bills, the infrastructure bill, it's supposed to be like $50 billion a year or something, incremental net supply. But it's all about the debt and what the budget's going to really look like. And so if this starts to increase again, we should be retesting the levels we saw at the end of the first quarter, because it's a complete reversal of all this. And remember, you couple that with the idea that the Fed is tapering, right? That's a marginal buyer going away. And so I think all of these things are extremely important, and I kind of kick ourselves for missing this with the general account, because we should have saw a little bit of this coming too. But it was a confluence of four things with the Delta variant, and all we got was that paltry rally. So I would argue that you've got to be very careful here in looking at the rates curve, and you want to be careful about stepping in front of it right now, because the narrative has changed significantly, and so has the policy.
Another one of our go-tos, copper gold, also says that rates should be higher.
Yeah, meaningfully, right? Like hundreds of basis points higher, right? So this is the whole thing you come back to. And this still says negative real yields, right? Even the copper gold telling us like a 275 10-year, you're talking about, I still said next year's inflation rate should be like 3.5, right? And so if you think about that, that's still a negative real yield. That still says bonds are pretty rich, right? But this argues that they're pretty dang rich at this point, if that's a phrase I can use.
I think you can say dang.
Okay.
Here's those negative real yields. They've obviously gotten better recently with the rise in nominals.
But this is why I hate tips. So what I want to lock in the guaranteed loss of 86 basis points per annum below inflation for the next 5 years. The only reason you should want to do that is because you think that the real yield is going to get more negative, right? Or inflation is going to massively be negative. You're going to have a deflationary environment. So buying tips is not really a good proposition from our viewpoint today. One, the distortion of the market, but this doesn't look like a good trade to me right here to go, okay, I can lock this in for 5 years, minus 163 under inflation. I was looking at the 86 of the 10-year. But I mean, does that sound like a great proposition to you?
Yeah,
I'd rather shorten up duration. I'd rather try to get a positive, nominal yield. Maybe I can keep pace with inflation and use my other book of business as an allocator, things like commodities, things like equities, to try to dig yourself out of some of this hole. So I still think tips are very unattractive today.
And here's the chart of the Fed and how much they own, about 20% of the TIPS market. So
yeah, what's funny is, we're looking at this 22 number, and I don't know, I like numbers, we all do, right? There's an affinity of that. But you look at how much they own of the on-the-run long bond, the Fed owns 22%. How much they own of the 10-year? 22%. How much they own of the entire TIPS market? 22%. So I'm like, okay, I pull up the 5-year, and I was disappointed. It's like 9%. So it doesn't work everywhere, but there's just something kind of eerie about that. So shout out to my my baseball idol as a kid, Will Clark. He was number 22.
All right. So devil's advocate, we look at historical real yields. There's long periods of times after World War II when the Fed did keep rates lower and did some yield curve control because they wanted to keep the cost of debt down, given the big debt burden they have. We have a very big debt burden right now. So there's an argument to be made that perhaps that's some force that could keep rates lower for longer.
Yeah, and you've heard guys like Larry Summers talk about this too, the financial repression, and look, this was the narrative post GFC, right, the global financial crisis, until we had this pandemic, right? And so, I think you have to ask yourself, are we going to go back to that? Are the long-term trends going to take hold? Or did we have a pivot moment? That's what the youngins say these days, you pivot, right? But if you go back and you look through history, there's always lines in the sand, and they're usually done by some social narrative that changes. And the social narrative that changed during the pandemic was social justice, inequalities. There's a lot of things they've done, and also nationalization versus globalization. And so I think some of those forces will be challenged. So look, I think Luke does great work. Luke Groman in his Forest for the Trees, I think they put out some great pieces there. But this one I think is difficult to extrapolate because I feel like we had one of those turning moments.
Yeah, JP Morgan just came out with this piece talking about the last 20, 30 years being the great moderation. It was like low growth, low inflation because of globalization.
Yep.
And
now you're seeing that dynamic change, and it started with the Brexit. It started with the rise of Trump and populism,
sure.
and so these things change. And so again, I think that I appreciate the work they're doing there, but time will tell. But I think just assuming we go back to that pre-pandemic world is a little challenging for me today.
Yep. All right, so now we're going to go through some inflation slides. Here's, of course, global CPI up higher than levels that we've seen for a very long time.
So this chart, what I love about this chart is that look at the difference in the developed world inflation versus the emerging world inflation, right? And this is why I love this chart. I was like, we got to use this version. Because what you see historically is that EM is where the inflation is, right?
Yeah.
Typically, it's the emerging economies. They run looser fiscal deficits. They have different policies, and they usually have runs in the banking system, right? So you got that inflation. But notice what's changed, right? This year, it's been the developed world driving that. Why is that? Maybe it's looser fiscal policies, right? The bigger debt burdens, and also we've opened up quicker too. So I find this dynamic very interesting, but you can see here that inflation tends to be a global phenomenon. And what I mean by when I say that is that it's not localized unless you have a banking system problem, right?
Yeah,
like in Argentina
issue,
or Venezuela, something like that. But what you find is that we all consume similar things. Look, in the US, we're not consuming a lot of natural gas, but we're being influenced by what's going on in the Eurozone right now. Some of the power generation problems you're seeing in China as well. So we're all consuming very similar goods. And so what you find is that inflation tends to be a global phenomenon. It's not as localized as it was, let's say, pre the fiat kind of currencies.
Mm-hmm. PPI an input to CPI on a lag basis, right?
This just tells me that inflation is not going to subside in the near term, right? Look at this chart too, because the blue line shows you the year-over-year growth, and wow, I mean, it looks like it's continuing to accelerate. But notice those green bars; those are the month-over-month numbers, and so this is not base effects. This is not because we had a low environment. We've been printing significant input costs higher and higher. And look at that, each month you're talking about 70 to 100 basis points each month, right? I mean, that is a significant increase in costs. And so when people say that there's no inflation, the Fed says it's transitory, go shopping, right? Go buy something.
Or listen to some of these earning calls with the CEOs of all the earnings calls saying that their input costs are going higher.
And it shows it right here. And so this is something critical to watch because we find that PPI leads CPI by about 6 to 9 months on that kind of lead basis. And so this tells me too that CPI is not waning in the near term.
Yep. This shows core CPI goods versus services. Of course, people have been buying a lot of goods recently and stuck at home, maybe buying new car, new washing machine, who knows?
Yeah, but also notice here too, for the middle of the teens and the 20 teens, we had deflation in goods, right? People attribute that to the Amazon effect and just, that there was this, so it's hedonic adjustment, so you have a better quality, it's the same price. So on the economic basis, it looks negative. But notice there that we saw the spike up when the tariffs came, in 18, when Trump instituted that. And then you saw the fall for the pandemic, and as you said, that resurgence. But notice what happened. There was a trade-off in 2020 between goods and services, right? We couldn't go out, right? The restaurants were closed. We couldn't do a lot of stuff. People weren't traveling and doing that. But notice that's come back, and goods have stayed elevated. And if you recall what we talked about 6 months ago, I was saying that we'll see, will there be this handoff to services and goods actually come down? But because of those input costs, we've seen, look at this chart.
Yeah, it's remaining elevated.
This tells me that something's changed, at least in this medium termish, and I'm calling the medium term right now like 18 months. And I think this doesn't go away. And then we have the other pressures of the labor market, we have the housing market that hasn't showed up in the CPI data. And so I just think in general, these are the things that are disconcerting about the idea that inflation is transitory. These charts don't argue that case very well.
Yeah, well, it's funny because transitory, is it 3 months, is it 6 months, is it 1 year, is it 5 years?
Is it my lifetime?
Yeah. I was reading Kathy Woods today was talking about all these kind of great technologies like the batteries and robotics and all that stuff's going to create cheaper goods in the future, but that's years and years and years away, and the bond market's worried about the next 2 years, the next 3 years. So while there's still this potential deflationary forces out there, in the long run, at least in the near term, I do think that inflation is going to be something we have to deal with. We're not talking about 1970s style, CPI, but we're talking about higher than.
But we're talking about what you used to, and like a lot of people, we joked, we're looking at the analysts around the virtual desk, and I'm like, how many of you have actually seen a world with a 3% CPI? Yeah. Right, and that you have to really go back. You had it 1 year post GFC where you got those prints, but you really got to go back to the mid 2000s, right? And so that's the thing where people haven't seen this. A lot of people who are professional investors, and so you have to dust off history. That's one thing we pride ourselves on, is looking at different regimes. And kudos to Luke, Groman going back, and looking in the financial repression of the 40s and the 50s. But I do think that, or the 30s and 40s. But I think that when you start to look at these things, you have to say maybe something did change here, right? Our behaviors are changing, our preferences are changing.
So one of the things that also helped keep inflation lower and abated, I guess, during the post-global financial crisis was slack in the labor market, right? We just didn't really see sustained wage growth. You can see that wages, looking at Atlanta Fed wage growth tracker, bumped up into the 3+ range a couple times. But now, I guess the debate is, could we see a permanent move higher based on what's going on in the workforce, just people not coming back to the workforce?
Well, if you dust off your economics book, you always see that there's a push-pull between capital and labor, right? So labor works, capital spends money to be able to invest. And what you're seeing is a rise of labor, right? I mean, you see this from the movement on, minimum wage. You see this for, just the shortage of workers in certain industries where you need to pay them more, right? And so for the first time in a long time, labor has a pretty strong upper hand, and we'll see if this leads to sustained wage growth. But, I like the Atlanta Fed wage tracker data series because it matches the same person to a year ago. So you don't have these compositional things that we saw, the noisiness in average hourly earnings and stuff. So, as I look at that chart, I don't know if it breaks out. That 4% seems to be the ceiling on things, but it sure feels like it in the market. It's a competitive job market, but also remember, there's the intangibles that people are looking for now too. So labor also doesn't just want wages. They want flexibility. They want benefits. They want a lot of other things in there. And so it's that work-life balance, I think, that is coming into focus as well. So definitely a very important chart to watch.
And potentially driving that is the supply-demand imbalance in labor markets. Huge amount of job openings, over almost 11 million.
Yeah. So as I was talking about at the kickoff too, people talking about the jobless benefits and they take this chart. Look at all the people that don't want to work. Look at all these jobs available. Remember, you have to have the skills for the job that's available too. And when I look at this and I see there's almost 11 million jobs, and they'll say, okay, you got these 8.3 million people in the labor force. well, how are they going to come back? Well, we just saw a bunch of people drop off the jobless claims on these extraordinary programs. So potentially that's there, assuming the skill set matches. But also, if you look at this chart, notice pre-pandemic. If you look at the job openings out there, we were running at the 7.5 million range, right? It was 7 to 7.5 million. That's where we were of jobs available. So it's not that 11 million new jobs have just come out of nowhere. On the margin, it's really been an incremental 3.5 million or so.
Yeah.
So I think that's very important as you think about the dynamics of the. I think it's a skills mismatch too. So we need immigration. We need people to do the jobs that we need. And so again, that's another thing about the social narrative that's changed.
It is pretty positive that you have an increased demand for workers, though, given the backdrop of what's going on.
It's great for the economy. It's great for broad participation. And so this is the opposite of polarization. So I say when you have the labor getting an upper hand and being able to do this, it's good because it brings the lower strata up. And that's something that gives you very broad economic gains. So I think this is a very positive thing. I know people talk about shortages. It doesn't feel good when you're at a restaurant and service is slower. But at the end of it, we're going to have to absorb this, and we're going to have to pay people to do the jobs that we want them to do.
And here's that labor force down from pre-pandemic.
All this tells me is that we have a more efficient economy. Our nominal GDP is at new highs. Our real GDP is at new highs. We're getting closer back to those trend line growth, and we're doing it with fewer people in the workforce. So it tells me we've had an increase in productivity. That's a good thing. That's another way of decomposing GDP.
We're one step to everyone letting the robots work and us sitting around and pursuing leisure activities, right?
Yeah, I guess, do we need more Shinodas and Shermans sitting around pontificating about things? I don't know if we need that, but we'll see.
So here's one of the things that I find interesting. This is part of the reason that labor force participation hasn't come back, is that there's just a change in people's behavior. Trying to analyze investments, a lot of it's trying to figure out the changing behavior, both what the consumer is going to do, what our businesses are going to do. Are they going to go back to the office? Are people going to go travel? Are they going to use hotels as we look at the CMBS market? And here is one thing I ponder, is that will this greater than 55-year-old part of the workforce, are they going to ever come back, or are they permanently going to retire? A lot of press about this, a lot of articles being written about this part of the workforce saying, you know what, I'm higher at risk, and I've had a good run, and I'm going to just enjoy my life.
Well, I think this chart's a little misleading. If you take it back another 10 years prior, you'd see that there was a spike post GFC in this cohort in the labor force, and some people are saying that was the financial repression, the low savings yields out there, and so I think all these things need to be taken into account together. But what this says to me is that it's exactly that idea. They need to be incentivized to go back to the workforce. But the other thing that could incentivize them is if you have elevated levels of inflation. So you erode the savings account, you have negative real yields out there, that could change this dynamic over time as well. So I think about the FIRE crowd, the folks who are trying to retire early, right? Did they calculate a 3 or 4% inflation rate there? I don't know. So I think it's dangerous to extrapolate these trends, but you're absolutely right.
Or a 1.5 yielding tenure, right, where they could invest and how they could live off their investments.
Yeah. Well, that's why you have cryptos. You can go speculate. You knew I couldn't resist the crypto.
Another thing that's gone up a lot is, of course, housing, sector that I obviously follow very closely, given I'm investing in mortgages, and it's been a crazy run, almost 20% annualized home price appreciation. Of course, combination of low inventory, low mortgage rates, and this demand increase given the pandemic that we all know about. So one thing that we watch a lot is affordability on the right-hand side. This is calculated using median income, median home price, and then the mortgage rate. You calculate a mortgage payment, and you look at that through time. Even with this big run-up in prices, affordability is still higher than it was through much of the 90s and the early 2000s. So this is positive for housing. The biggest threat in my mind to housing is, of course, rising interest rates. That's going to make the payments go higher.
Yeah, the headline today was that mortgage rates blow through the 3% rate. It's a 3.01% 30-year fixed rate. And when I was joking in the investment meeting, and you said, yeah, but think about the context of history, right?
Yeah.
And this is exactly what this chart tells you, is that in the context of history, it just still says that, because of the low rates, you can get a lot more house, right?
And I think when I look at this, this affordability number plus this housing inventory number, I've been talking about this for too long. I keep saying I've been talking about it for too long, and it keeps going lower. It's gone up recently, but If you look at the global financial crisis, one of the reasons home prices went down, there was this flood of homes in the market, right? Foreclosure sales, we got up north of 3 million existing inventory. We got down to about 1.5 million pre-pandemic. We got down below 1 million. So there just is no homes on the market. You open up any newspaper, it talks about, some, millennial couple trying to find a house, can't find homes, not enough homes on the market. This is positive and supportive for housing. So while rising rates can pressure home prices, there's no flood of homes in the marketplace. So home prices, they can go down, but they won't go down to the extent that we saw, of course, during the global financial crisis. So they went up 20. Can they go down 5? Sure. Will they go down 30%? Probably not.
Yeah, and it's healthy too. Like I think it's so funny because when the stock market goes down, you get everybody on TV and they say it's a healthy correction. Well, you know what? That can apply to any asset too. And look, 20% per annum is not tenable, right? Unless we're having inflation. Wages have to grow. Wealth has to grow by that. So, it's something that it doesn't set for the long term. And so, yeah, some correction in some areas is healthy for that because it also flushes out weak hands, right? And so there's something to be said about that. So, look, even if we decelerate to a 5% HPA, house price appreciation, that's a very healthy, strong market.
It's actually
right?
the long run average during the post-global financial crisis era was about that 5%. So you would just go back to normal. And this, a lot of it, we say the COVID was a great accelerant. People, if they on the margin thought about buying a house, they did it. If they on the margin thought about moving from California somewhere else, they did it. And the places that have benefited the most were some of these low tax, low cost states and cities.
And also at the end of the day, if we go back to the 5% trend, that just means 3 to 4 years of no growth. So what? You're still in a good position, right? No growth in house prices would put us back to that trend. So, it doesn't, remember, housing prices tend to be sticky to downside. People don't want to sell, but you do have people that have a lot of equity, as you show on your other chart over there, right?
That's another positive. Yep. People don't force sale their homes if they have money in it.
That's
and
right.
One of the things that happened during the global financial crisis, equity got very low. People had no skin in the game. They started dumping their housing on the market. We were actually looking at the percentage of loans that are delinquent outstanding, and the number of homes that have, or borrowers that have less than 10% equity was near the lowest it's ever been. So we just think that's all positive for the housing market, that we won't see too much supply come, and that should be supportive as well.
When you gave that stat, one of the guys in my team sent a message to me. It was like, well, yeah, housing price up 20%, but I was like, someone's buying in the last couple of months, So it's not that everybody's up 20%, right? And that's a nationwide average, and it's biased by the larger cities.
I mean, in some places you could still be flat if you bought at the top in right before the global financial crisis.
Look at the Chicago chart, right?
That's right. So home prices are up a lot. Rents are rising because home prices are up. So everyone that's renting properties says, hey, I can rent my place for more. And that's something we talk about a lot because one of the things that we could see upward pressure on in the CPI number is OER, owner's equivalent rent.
Right. Yeah, no, and that's the disconnect. So you just showed that house price appreciation was almost 20% per annum. You show right here that the rental market says that year-over-year price growth is 11.5% in the rental market. And then you go, okay, I'm going to open CPI and look at owner's equivalent rent, and it's 2.6. So I always just point out there's a big difference between 20 and 2.6. And what that is, it's just there's surveys. It takes time for people to realize that if you're not in the market. And so, we think there's going to be some pressure there. That's why we think even some of these transitory effects like supply chains or used cars or airline tickets, hotel prices, they will dissipate. But you're going to get the handoff to this other side, and that's why I think it is a more sustainable, more tenable kind of level in CPI. And I just think we're going to go to where it's not a 2 CPI world or a sub-2 world. It's a 3 to 4% CPI for the near term. And so we just have to get used to that, which again, on some of these assets makes you scratch your head. What are they doing priced at such negative real yield?
Yep. We talked about, if we're not talking about the bond market, we got to talk about the credit markets. We talked about this earlier at the beginning, just saying that the probability of default is very low in the marketplace, levered loan default assumptions on the left-hand side. And so we think that the credit markets should do okay. Some parts of the credit markets are still cheap relative to history. It's really kind of a bond picker's market. There's not like a big beta trade anywhere, but
we've loved the CLO market all year. I mean, we started really allocating a lot of capital last year there. We continue to do so, and even though those double B prices, and again, it's hard to get double B CLOs, like they're small size out there, But if you're getting stuff that yields 7 without interest rate risk and you're in a benign default environment, it's a pretty attractive asset today. And so, look, you can't build a big portfolio with them. Look at that. I mean, you can have a 40% drawdown in weeks, as we saw back in March.
Yeah, it's definitely volatile.
Yeah, but at the end of it, too, for a risk-taking behavior, sounds a lot better than going out there and buying necessarily like a broad-based basket of high-yield bonds that yield in the low 3s, right? So there are some things to do there, and you don't have the risk here. This isn't priced off the 5-year part of the curve. This is going to be priced just off the front end, right? You have spread duration, you have credit risk, but for those that are sophisticated enough to do it, we think it's a very, very interesting trade for risky portfolios, of course.
So we went through tons of charts, maybe confused people with a bunch of different ways to look at inflation, look at the bond market. So what do you do in your portfolio? Well, simplistically, if you think there's going to be inflation, you think that nominal rates will reprice higher, maybe not a lot, but just slightly higher, then you want to be shorter duration.
Yep.
So that's one thing, that's an easy way or an easy theme you can put into your portfolios. And then another thing that I bring up to investors is so much investing has been driven by 60-40, index investing, low-cost investing. And the problem with the concept of 60-40 is it works when there's an inverse correlation between your 60 and your 40. And since the early 2000s, it's worked well because bonds have moved inversely. So stocks sell off, your bonds go up. But in periods of higher inflation, the two assets can move together. So on the
you saw in the 90s, for instance, right?
And so the bottom of this slide is just to simplistically look at. That's that correlation, and it was positive from the 60s all the way through the early 2000s. This is a 10-year rolling average, so it could have gone negative sometime in there. But that time period, it's when inflation is higher, right?
Sorry, I didn't mean to cut you off, but I did because I kept talking. So the 1 month and the 3 month, you notice here too that we had a lot of positive correlation this year between rates and stocks, right? Rates were going up and stocks were doing well. Then all of a sudden, we actually got the offset, right? So, if you start to look at this dynamic, you have to think about what drives this. And you can see that bond correlations aren't always negative. They have been, in a lot of people's careers.
Yeah.
But there's something about a certain level of inflation that has to get repriced at some point. And that can really shift the dynamic because as the bonds reprice, it in the short term, it's going to reprice the equity market as well. So it's being careful about extrapolating this idea. It's like, well, if rates go up, spreads have to tighten in. I hear that all the time. And we know in short periods and even medium periods, that's not always the case.
Yeah. So I just use this slide to say, hey, just something to think about as an asset allocator. Let's say you do believe in the 60-40. Does your 40 need to be as long as it has been, as long as it is today? And a lot of people for the 40, they just like using the index because it's they say what can go wrong? I'm using the index. Well, here's the index yield and duration through time. It only goes back to 1991. That's when the duration of the ag was tracked before it was this yield. For many, many years, the duration of the ag was more like 4.5 years or so on average. And it's really not till recently with extension of corporate bond duration, extension of issuance out the treasury curve, that the duration of the ag is literally near the longest it's ever been. It's up over near 7 years.
And I'll add to that. When yields go down, durations go up too. A lot of people don't know that concept, and that's also part of what's driven this as well.
So from as you can see, yields have also come down a lot. So the yield per unit of duration that we like to look at, it's the most unfavorable it's been. This is our case for active management. We're not going to put you into this portfolio, but for those that have been using passive, and look, it's worked. Rates have come down.
Right. And look, I've had a lot of client reviews that said, well, you missed the trade in March of last year, or you missed it all last year. It's like, wait, we missed March, right? And then we said, we're not going to go out and buy this duration because these metrics you saw last year, it was the worst yield per unit of duration. And so why does that matter? Well, the intuitive appeal of that is that if you assume over the next 1 year, right, you're going to get your yield. There's no defaults or anything in there. The yield to duration tells you how much can interest rates move upward before I erode all that yield to price depreciation.
Yeah.
And notice that this gives you, if rates move 30 basis points, you're going to have a negative rate of return over the next 1 year, with all those assumptions baked in. And so this shows you how sensitive you are to price and the entry point within this market. And it's much easier when you got a lot of coupon. You can make a lot of price mistakes, right? But now the margin for error is so thin. And like you said, it's the juice got squeezed out last year, and that just says that you pulled returns forward. So you got to adjust expectations going forward.
And look all the way till the global financial crisis, almost north of 1 usually. and so you had a lot of coupon to help you with any price declines, and of course the duration was lower. So just something to think about if,
and this
if you're
looks worse.
60-40.
If you go out to the global market, it's worse.
Negative
right?
yield.
Yeah, it's even worse. And so, and it actually has a longer duration when you look at because you have negative yields, plus the debt is much longer on the sovereign side. So what you find, because they do 100-year bonds and things like that. So what you find here is that it's even worse when you go outside the U.S. in this dynamic. And so, obviously we're talking our book here, we're active managers, but at the end of the day, I can't think of a worse place to try to put a client right now than this type of index.
Yep. All right, let's move on to the land of gains here, equities and commodities.
That phrase never gets old, by the way.
Yeah. One of our favorite phrases around here. All right, so it's been a great run for developed market equities, positive largely around the board. This is all total return in US dollars. Of course, China weakness with Evergrande and some of the other things going on there. Emerging markets, more of a mixed bag. This is largely around currency with some crazy returns. Different stories, you look across the different sectors. Energy, basically the laggards of last year seem to be catching up this year. Energy, financials, and real estate, I think were the worst three performers last year, all playing catching up.
You are correct, and that's the kind of the value trade, right? Those are traditionally the value areas. But also notice utilities over there too, right? Was the darling last year, but it's sensitive to rates, right? At the end of the day, and valuation is pretty stretched there. But this is one of the larger dispersions you've seen across the sectors in really a long time here too. And so this is where sector rotation can help. Obviously, we have a sector rotation product in the equity market. It pulled us out of tech last month, right? And I'm like, oh, here we go, and
tech's gonna rally.
Tech's gonna rally, just joking. It's always our joke. But look, I'm like, I like the setup for higher rates. It's a long duration sector of the market. People don't think that way. But if you talk about these cash flows that have high multiples, that's what you see there. So, I mean, look, this is still the land of gains, right? 5%. You're not seeing that in the treasury market, right? That's 4 or 5 years of gain. So, I think you're seeing a healthy change in leadership, and we'll see if this transcends. But I think if you get a continued rate move upward, I think some of these trends continue here. And the longer duration, the things that have high multiples are much more sensitive to those cash flows as you reprice your discount rate.
Yep. So valuation. Here's the CAPE ratio, which you spent a lot of time talking about. And it's high. It's not as high as, I guess, early 2000, but it's up there.
It's only been higher twice in history. And I like to say that one time when it was at this level, it went down 50%, and the next time it went up 50% before it went down like 60%. But look, at the end of the day, valuation can stay stretched. There's rationale for some of it. Rates have something to do with this, and also quantitative easing has something that's pushing people out the risk spectrum, right? Where bonds don't look attractive. And so I think we've been on record all year saying that, equities look rich, but not as rich as bonds look, right? Especially treasuries. And so there is some merit to this, but also sector leadership, change in the underlying, kind of sectors of the market can really change this dynamic as well. And so just, once this data gets updated for September's performance, you'll see the valuation came down a little bit.
This is a little old. I think this was from earlier this year or last year, but I still think it's something interesting to look at. It just basically shows you historical returns when you get up to these high CAPE ratios, and it can still be positive. You can still see positive returns. Of course, you buy at lower PEs, you have a higher probability of having better returns.
And these are 10-year returns, by the way, on when you look at that too, and you really should be looking at real returns as well. So, look, you still have a chance of making money, right? If you look at that, it's a frequency distribution. So even at the CAPE north of 30, you can see that there are periods where you get solid returns, right? So I wouldn't expect them to be, at the right end of that tail there. But look, you can get positive rates of return, and this is done in nominal sense. But if we're going to get some inflation there, it may hit the equity market in the short term, but pricing power will push through. And at least you usually see, once you get those inflationary regimes, that it decreases the multiple, which is your correction early on, but it gives you that kind of nominal protection over.
And that's one of the reasons that, with real rates negative, people are forced into other asset classes, and they just look at this and they say, at least I have a chance.
That's right. So what you're saying is there's a chance.
Okay, so we have a bunch of kind of relative value charts. This just showing what looks cheap. Everyone says the market's expensive. Well, it's all relative, and there's still some things that still look relatively cheap because they haven't gone up as much, which means they've been lagging. And of course, value for a moment, was outperforming in the first quarter, second quarter, early second quarter, and then that reversed. And some argue that maybe now is the time for it to shine again. Very recently, last week or so with the rate move, financials have been outperforming.
I liked it in the first quarter. It didn't work in the second and most of the third, and here we are back to the same level. So it's the old thing. If you liked it before, what's changed? I think you got the catalyst for higher rates. You got a Fed that's moving. You have a reopening of the global economy. And so, the reason I think about this is growth tends to be a longer duration asset, but also when you think about value, when growth is scarce, right, it trades at a premium. Growth is not as scarce anymore, right?
Yeah.
So this argues for value, and value always has that risk premium. It's a higher risk asset. People don't realize that. They think growth is riskier than value, but value tends to be there because it's depressed. So ultimately, I still like this chart. I still think value is a good place to rotate into. And look, our rotation strategy has primarily in the value sector. So it's all kind of consistent with what we're seeing from valuation standpoint.
Yep. Also, the S&P 500, of course, being the U.S., has outperformed non-U.S. This looks at ACWI excluding the U.S. So you can see the huge outperformance of the U.S. The U.S. has definitely been winning.
Yeah. Well, look at this too. When you look at the ex-US, look at how we're at this kind of double top too. We're back to that level we saw in the 06, 07 boom when the globalization really took off, right? And so I would argue here that you wait for the breakout, right? If you can exceed that level and you start to get a little momentum, that's when you really want to really pile into this non-US trade. So you can see that relative outperformance, that black line you show at the bottom. But I just look at that blue line and say, I'll just wait here as a technician. I'll wait for a little bit of breakout, and then I'll go heavy in that rotation. And so, I think we're on that precipice here, and we'll see if the land of gains moves to the rest of the world.
Yeah. And here's European equities versus the U.S. This is the one that's always looked cheap, keeps getting cheaper.
Yeah, you remind me of that. I was like, well, Europe looks cheap. Like, it always looks cheap.
Yeah.
But also remember, Europe tends to be more value-oriented than growth as well.
Just the companies, they're not really a big tech hub, right?
Right. Yeah, they tend to be more healthcare. And people argue about healthcare. Is it growth or value? But the manufacturing industrial side of the equation, and they have a lot of energy production as well, especially clean energy. So, I think this augurs more, you need the value rotation to play out too, because it's more of a value-driven economy.
And then let's combine the
market.
Let's combine, this is, I can't see my screen here. What is this, equities? Oh, this is the CAPE ratio of the two. And from a CAPE ratio standpoint, of course, it looks cheaper too.
It's cheaper, but history says that it's probably, if you look at that, it's probably around average, in the European market versus necessarily in the U.S. market. So, look, it is a cheaper area, and I still argue that there's nothing wrong with owning some European equities today.
And we've seen some more flows coming that way across not just our funds, but across the board. There is money moving there, especially as you're seeing kind of light at the end of the tunnel with COVID. You're seeing better growth numbers. You're finally seeing inflation after. And
you're seeing them reopen. Remember, they had severe lockdowns too. Remember, Europe is not the U.S. Like, there's a lot of parallels because of the EU and the EMU, from the monetary side. But remember that these are distinct countries, right? They have long histories of not liking each other and everything. So when it came to lockdown, it really became lockdown. You don't have that mobility that you have in something like the U.S. So again, as it reopens, as you said, the vaccinations, you're seeing policies move that direction. It makes me pretty optimistic, as we have been a long time. And we turned pretty bullish on Europe over the course of the summer.
And of course, value versus growth in Europe, similar story to the U.S. Also looks cheap, had a little rally, and could be a similar setup. So these are all pockets of relative cheapness if you're trying to still buy equities and trying to figure out where to go, and you just don't want to buy the S&P 500, which of course could do well as well. Yeah, but in our asset allocation model, we started to overweight European equities over the course of the summer, and it really hasn't worked yet. But it hasn't been horrific. It's made money. It's just it's made a little bit less in the U.S. And so we still like that position. And I think really at the end of it, it's that dollar move too. When that dollar move kicks in, it's going to be very, very strong, a strong tailwind for the European market. All right. So inflation is here. These are also some slides that are a little bit older, but I think that they're still relevant. These were from March of 2020. JP Morgan did a study about how stocks in general can do during periods of inflation. So as we've been saying, inflation is going to run higher. It's not going to be 10, 15% CPI, but if we're back to this kind of 3 to 4% area, stocks can do okay.
Yeah, and what we'll show on the next slide is the multiples, but at the end of it, what you find is that in low growth environments, low inflation environments, you put a premium on cash flow, right? And so that's why the multiples are higher. So if you look at this chart here, which just shows, okay, how does the PE respond in different inflation regimes? And remember, that what we have boxed there is where we went to where we are currently, but also that's about half the observations. I think if you go back, it said 47% of the observations if you sum those two. So this is the bulk of the time where the market spends in these regimes, but also notice that as we've done this, as we've increased our inflation, the multiple has come down a little bit. Earnings have accelerated, right? We had huge earnings growth in the second quarter, right? And then prices kind of stabilized, and they've been retreating in the month of September. So this is according to the playbook. It is set up, it's going that way, and you can still see multiple compression, but at the end of the day, it's gonna come down to the earnings side. So do we grow back into the multiple? And so even if you have a multiple compression, if earnings are accelerating in that, it can offset that, giving you the landed gains. Had to throw it in there.
Yep. And it's just, here's another look at what does okay during these periods of inflation. And obviously commodities, as we stated, high yielding credit can do okay, given its typically shorter duration. Even though we had some negative comments about it, given the current valuations, it can still do okay, and it has. And of course, developed market equities can do well in that environment as well.
Yeah, and so what's probably missing out of most people's portfolios is the commodity piece, right? Everybody owns developed equities. They probably are way overweight the U.S. People that can't stomach the low yields in the treasury market have moved out the high yield curve. But that commodity has been the place that's been under-owned and underappreciated. And I still think, even though there's been a strong performance, I still think that you've got another year to two because of the supply chain side of the equation.
And my computer went dead, but the next slide I know is a slide of commodity year-to-date performance. But it's been kind of this like moving animal of different parts of the commodity market kind of driving the performance this year, right?
Yeah, and that's the thing. That's why you want to own baskets. You want to have a diversified commodity exposure, because commodities are one of those sectors that there's two benefits to this. Is that typically if you look at dispersion, there's always something extremely positive and something extremely negative on the commodity front. But also there's a correlation aspect. So you get diversification by building the baskets. Remember, commodities have inherently high volatility, right? The lowest vol tends to be kind of the precious metals, where energy has the highest vol. Look at nat gas, how it's exploded lately. The volatility has exploded. And so, as you put it together, you get this benefit from it. There's some great things about the term structure. A lot of people don't realize this, but if you look at the term structure and forward prices are lower, that's a positive for commodities, because as an investor, you're buying out and you're rolling up the price curve. So again, it's technical nuance, but it's not signaling that ultimately we're going to have a lower commodity price in the future. It's just that there are supply constraints. That's what it's telling you. And the market currently exhibits more backwardation, or this dynamic of being supply constrained in the price curves, more than we've seen really since 2010, right? That reflation argument. So even though you've had a strong performance, if commodities move somewhat sideways-ish, you have this underlying dynamic of the way the price curves are structured today, that ultimately it can still be accretive to performance. And so again, I've been pounding the table on commodities for the last year plus. We took a little bit of breather. We got a little neutralized because we were worried about the dollar. They've held in there. So it's making us, we just kind of want to see another breakout there too before we move to that next overweight step.
Yeah, that's the next slide that I can't see, but I know is there, is BCOM,
Yep.
right? And if you look relative to that big run up, kind of in 07 before the global financial crisis, I mean, do you think we'll see something like that, or what do you think?
Yeah, I think we get to triple digit oil. I think it's pretty undeniable. There's an energy problem again. We've seen the producers in the U.S. The shale hasn't recovered yet. The rig count is still extremely low, and OPEC is incentivized to keep prices high too. So I don't think it happens linearly. We had this $10 up in oil, $5 back. We're kind of in that $5 back stage again. Brent touched 80 this week. It sold off from there. But I just think the next move continues higher in that area. And I also think that those higher input costs lead to higher commodity prices, through the base metal side, because that's a function of refining as well.
Yeah.
And so you don't buy raw copper, you buy refined copper. So it has to go through that process. And look, the food stuff, you're seeing this across the board. The challenges with the climate change have led to really this shifting dynamic in food prices. So don't worry, the EU is going to roll it out. It's going to be all commodity speculators' problems. they're the ones that drove up food prices, when a lot of it has to do with just the change in the weather patterns. And so I still like the commodity complex. BCOM's a little distorted because of its high exposure to natural gas. Natural gas is almost 15% of that index today. So as that runs happen, you've seen that. But if you pull out nat gas, it's right on the cusp of that breakout again. So I think you can see that, is it the secular bull story that we heard in the early 2000s? I don't know. I don't think that's the case, but I definitely think that as the world reopens, there's going to be just more intensity and more demand for commodities, and the supply side just can't keep up in the short term. It'll take a couple years of high price to get there. So as an investor, there's still an opportunity.
Yeah, and I think a lot of people just gave up on them after a decade of going sideways to lower, and so it's probably underinvested or underallocated in investors' portfolios. So it's probably not a bad thing to add for some diversity and some.
Hey, and as you said, there's always a chance, right? Right? Yeah, they don't have any yield, and look, the idea of the dollar is a very important one because they tend to be globally priced in dollars, and so this concept that they've hung in there well with this last dollar rally, over the summer, tells me that there is this support there that ultimately, if you price it in another currency, the commodity market looks very strong.
All right, well, that's it for our segment of What Now?
What Now?
So
I feel like it's an SNL skit, So,
so we stay short duration. Credit can do okay. We think we'll see some choppiness in markets, though. And then we walk through kind of where in the equity market there's some relative value. And we think commodities look interesting here as well to kind of sum it all up.
Yeah, and so I'll look forward to my next invite back.
Yeah.
And we'll do What Now again, and we'll take the scorecard, and hopefully we can do some high fives, and we'll all experience the land of gains.
All right, everyone have a great fourth quarter.
Okay, take
and
care.
a wonderful holiday season. Take care.
Thanks.